There's something I've been saying on this channel for a very long time now, and the more time that passes and the more traders I've spoken to over the years, the more and more convinced I am that this is absolutely true. Here's the thing. When you identify a problem with your trading, whether it's something that's stopping you from progressing to the next level or harming your performance in some way, and there are many problems and many common ones that traders experience, that often those are just the symptom level problems. And those are the things that everyone's spending their time and attention trying to solve and fix and overcome. But just like anything, if you treat the symptom without actually finding out the cause and treating that, you're not really going to get very far. And with all of these problems, when you dig deep to find out what the root cause is, there's usually just a handful of them that are behind most of the problems that traders experience. And one of those root cause problems that come up time and time again is about people's perception of what trading is, what they should be doing, what they shouldn't be doing, what the aim of all of it is. And I think that a lot of traders need a complete perspective change to understand trading in a completely different way that will therefore set them on a much better path to maybe succeeding at this, because let's face it, most traders are failing, and to at least feel like they understand what they're doing. So in this video and in the next couple of videos, I want to walk you through a series of mental shifts that you can make that will change the way that you look at trading and set you on that much better path. And to a certain extent, these different mental shifts are all interconnected. So I want you to look at them as being one overall thing. And these are topics, they're the kind of things that I usually get a lot of pushback on, where people say, oh no, that's not right, because it's different to what they've been told for the years before that they've been learning to trade. All I ask of you for this video and the next ones is that you keep an open mind and try your best to understand what it is that I'm really telling you, and don't just make a judgment from one thing and say, no, that's different to what I understand, so I'm not going to listen. Because what tends to happen is that when we release these sorts of videos where it's about some sort of paradigm shift in some way, then later down the line we start seeing it appearing on other people's channels. People email us later down the line saying that at the time I didn't understand what you were saying, or it didn't resonate with me, but now it's really helpful. And I think that if you just keep an open mind, you'll maybe see what I'm trying to explain to you, and I really think it will have a good impact on your trading. Now, just quickly before I share my screen and we get started, I just want to say, for any regular viewers of the channel, I'm sorry that I haven't posted in such a long time. I think it's like 6 months since our last video. I didn't intend for it to be that long, but I just got busy with other things like my own trading, different projects, our community, and so on. But during that time, I still did send out training videos and different things like that to our newsletter. So if you want to make sure you don't miss out on anything, the link is in the description box. It's free to sign up, and that way you can receive more training, insights, and also I'll be starting again my end of week email, Nicholas's Notes, where within that email, I also put out a video or a post breaking down some of my trades from that week. So if you want to stay on top of what trades I'm taking and have more shorter insights in that email, then that's where you need to sign up, and that way you don't miss out on anything. Although I'm hoping it's not going to be another 6 months before I release a video, hopefully just a matter of days. Let's see. Famous last words. So in today's session, and like I said, it is part of, like, you could think of it as a series, I want to talk about the concept of intentional statements. And here's what I mean by that. So you can see it on screen there, that every time you take an action or make a decision in the markets, you're making an implicit statement. So you're implying something through your actions. Actions speak louder than words. When you put your money behind something, then you are saying something about the thing that you're putting money behind. And when you make adjustments to that in some way, you're also saying something. Like, think of it outside of the context of trading. If you're putting your money behind something, what is it that you're making a statement about in that situation? So we are making these implicit statements, but most traders don't realize what statement they're actually making. And if they knew the statement they were making through their actions, through their decisions, they wouldn't necessarily agree with those statements. And so, of course, this leads to unintended consequences. And there's something I've talked about before on this channel, but I want to bring it up again because I think it's relevant here. That I think about with any activity, not just trading, but you can think about different sports, different, I don't know, games, activities, hobbies, that everything can fall on this sort of scale, this continuum, if you want to call it that. And it's the luck skill continuum, or skill luck continuum. And we can think about everything, every activity, as falling somewhere on this scale. So for example, if we think about playing, I don't know, roulette, if you didn't have technology that tells you where the ball's going to land, which do exist, those different types of technology, it's going to be all the way down here, 100% luck, right? And if we think about something like chess at a high level, you don't win a game of chess like when it's grandmasters playing against each other. They're not winning by luck. It's based on skill, strategy. It's almost entirely up here. And so we can think about different activities falling somewhere along here. And the thing about trading is that it can be all the way down here, 100% luck, because we all know that people can jump into the markets, take trades completely randomly, just basically gambling, like what most new traders do, and therefore it's entirely luck because they don't know what they're doing. But actually, surprisingly, I'd say most traders fall in this area here, maybe not as far this way, but somewhere in this area, because although they think they're doing something meaningful, they think they're analyzing something that's meaningful in the markets, they think their strategy is meaningful, actually the way they're trading is no better than just flipping a coin. It's all like false causality, clustering illusions, and things like that that make them think the thing they're seeing is actually going to be predictive in some way, and it's not. And so what we're trying to do as traders is to move as far as we can this way. But we have to always understand that we can never go 100% at the skill side because the markets are out of our control. We can control what we do, but we can't control what the market does. So we can never say it's 100% skill because there's always an element of luck. Because another way to think about this is rather than it being luck and skill, we can say that it's things that we can't control and things that we can control. So we can control our actions, we can't control the markets. So we can never get all the way over here, we can get as close as we possibly can. Now, here's the thing. If you're making statements with your actions that you don't realize you're making, or you think you're making a different statement, then obviously you're taking actions or doing things that are no longer in your control. So rather than us moving this way with things that we can control, we're actually moving this way because we aren't fully in control of the actions we're taking, or we're in control of the actions we're taking, but not in control of what we're meaning by those actions and what we're intending by them. And so there are unintended consequences because there's an element of luck to it. And so if you want to trade better, you need to be aware of the actual statements you're making, and you need to make sure that your statements are intentional. And when you look at great traders, whether they realize it or not, they get really good at expressing their analysis in the right way, that they end up making the right statements through their actions. And I think this is part of many skills, that there are two broad categories. You have the part that most people pay attention to, which is whether you can actually execute the skill, like can I do a tennis serve the way it's meant to be done? And then you've got the part of actually being able to know when to use the skill and how to use the skill. So I don't just want to serve in tennis and get it in the right area. I'm also trying to direct my opponent in a certain way. Like you always hear about sportsmen and women who get to the end of their career where they've got a bit older and their body's failing them. And they often talk about this moment where they can see what they need to do, but their body just doesn't respond in the way that they want it to. So they can see the skill they're meant to be executing, but then they can't execute it. And with beginners in lots of skills and sports, it's the opposite. They execute something but don't know what they're doing. So think about if you don't know anything about chess, you know where the pieces are meant to move, like how the pieces move, but you don't really know about strategies or things like that. Well, if you're playing against someone who knows what they're doing, you might make a move and they're reading what you're doing and thinking, they're trying to do this is the statement they're making, when you could just be doing it randomly because you have no idea what you're doing. Okay, so we have to keep this in mind in trading, especially because it is a skill that involves strategy and it's a complex skill with lots of different subsets of the skill that we need to, or a whole skill set that we need to develop, that these things are critical for actually succeeding. So let me explain a bit further what I mean by implicit statements, and you can get used to my questionable visuals here because I'm going to end up doing these like flow diagram, mind map type things from now on. And that means that it's up to me to put in all these random stupid things. So what do I mean by implicit statements? So I think a good way to think about this is to imagine someone who knows nothing about you. So that's why I've got the alien here. Imagine an alien arrives on Earth. They've been studying human behavior and culture and the things we do for decades. And now they're here to understand more about us. And so the alien comes and knocks on your door and says, hey, can I come in and try and phone home? And while he's busy doing that, you say, look, this is what I've just been doing with my analysis in the markets. Since you're interested, I've just taken this action. What do you think I'm implying by this? Like, what do you think my belief is about the market by taking this action? And the alien, not having the bias that you have in your mind and the statements and the understanding you have in your mind, will purely look at the logic of the actions and tell you, well, if you're doing this in this situation, surely that means that you think this about the market. And so for most traders, whatever that sort of objective view of the logic of the actions would be, is not necessarily what they're intending. Because unfortunately, most traders just take actions in the markets, make decisions without truly thinking through the logic behind them. And it's often because of things that they've been taught and things that are around the trading industry. That because people have repeated the same thing so many times, everyone assumes that that's the way that's done and that's what that action means, but it's not necessarily the case. You see, this whole, let's call it like a ecosystem or microcosm, this trading industry, it's a race to simplicity. That the more simple you can make something sound, the easier you can make something for someone to pick up very quickly, the more people are going to follow your stuff and learn with you. And so it's a race to having things being as simple as possible, but simple isn't always correct. And in fact, in this case, a lot of the time simple is not correct. So people boil things down to simple rules and simple actions that every trader should be taking in certain situations that are often illogical. And when you break it down by thinking, hold on a second though, what statement am I actually making? You realize it's illogical, and that's when you set yourself on a path to doing things much better, where you can control the situation, control your actions, and lead to more intended consequences. Now, what we've been through so far, for some of you, will already be helpful. It would have opened your eyes to something and you'd be like, I know what I need to start changing. But for most of you, this will all be just a lot of talk so far. Fluffy stuff, a lot of blah blah. We often get people commenting on this channel complaining that you're talking too much. But the reason for that is because if I just focus on the explicit rule or the action that you need to take, then if you're in a complex situation or when you come across a challenge or an obstacle that you're not familiar with, you won't understand how to adapt. And adapting is an important part of trading. Whereas I believe if you understand the logic behind things and the rationale and you click with that, then you can take the right actions in many different situations for the rest of your career. So there is a lot of talking behind this, a lot of theory or concepts behind the things that I explain, but the reason is because I want you to deeply understand it. So just stick with me, but we are going to make it a bit more practical, and I'm going to walk you through some examples now. So I want to begin by giving you some simple examples from other areas of the industry, so other market participants like investors and portfolio managers, and those will help you to understand the concept. And then we'll go into what it means for you as a retail trader, spot trader, and some of the main ways that you make statements with your trades. And then we'll wrap it up there. And in the next video, when we talk about the next mental shift that's even more critical than this one, this concept of implicit statements will tie in closely with that. And we'll go into even more detail then. So slowly you'll build your understanding of this, and it will be a game changer for you if you follow what you're learning here. Okay, so let me start with a really simple example. Do you remember right at the start of the COVID pandemic that we had that situation where there were cruise ships that had to be quarantined, where someone on board had coronavirus, so the entire cruise ship were not allowed back on land and they had to be quarantined for like a week or two. And there were a couple of them, I think. And that was right at the start where, these headlines dominated every media outlet. So everyone was paying attention to the same news before everything got so widespread that everyone was paying attention to different things. And so we ended up with articles coming out like this one over here saying, is this the end of the line for cruise ships? And as a result of that, as you'd expect, some of the major operators, their share prices plummeted. Now, for some poor investors that would have invested here or somewhere in this region around here when things were relatively stable, some of them would have still been holding when the price got down here. Some of them, of course, would have been lucky enough to get out, hence why the price was dropping as investors were trying to get out of their positions. But some people would still be holding here. And some people that are holding here would be choosing to stay holding. They'd become bag holders, as we like to say. Now, those people, if you ask them, what's their reason for holding? So you met one of these people and they've got, I don't know, £100,000 invested in Royal Caribbean cruises, and you say to them, why are you still holding? They'd say something like, well, eventually the pandemic's going to end, people will go back on like cruises, the whole company will be back to normal, and the share price will recover. So rather than taking the loss now, I'm going to hold on until that happens. And you might listen to them and say, yeah, it makes sense. I could see that happening. And it'll be the same for other companies. Like I remember at the start of the pandemic, cinema companies were suffering in a similar way, and so on and so on. So that's the statement that they're making, that they are holding this because they believe at some point the share price will recover. But if you give it to someone that's not going to be listening to their statement, but just going to look at the actions they take, what is the implicit statement they're making? What are they implying by keeping their money held up in this company or these companies? Well, they're implying that that's the best place for their money. Because if it wasn't the best place for their money, they would sell their shares right here and invest it in something else. And can we not all think of companies that were destined to do so much better than cruise companies during the pandemic? For example, we all knew that people are going to be working from home, working remotely, people aren't going to be out as much. Therefore, video calls are going to be in demand. So companies like Zoom, I was going to say Zoom, but that's a bit too cliche, skyrocketed at that point. And in fact, a company that was called Zoom, that wasn't even the video call Zoom, video conferencing company Zoom, also zoomed. There you go, done it. Because people are too stupid to actually check what company they're investing in. They're like, take my money, and it was a completely different company called Zoom. But anyway, there were obviously better places for the money during this time. Even if you think it's going to recover, there are always winners and losers in any situation. If an industry is collapsing, there are still winners and losers. If an industry is taking off, there are winners and losers. Winners and losers in terms of companies exist when there are paradigm shifts. And when the pandemic started, that is a major paradigm shift. So of course these companies may recover somewhat, but there are better places for your money. If you took one of those investors that were holding on, and if somehow you could wipe their memory of having these positions and say to them, okay, I want you to look at the entire market and pick out where you think the most important industries are for you to put your money, or the best opportunities. What do you think they are? Do you think any single one of those people would choose cruise liners that currently can't operate and people aren't going on holidays? Of course not. So the statement they're implying doesn't align with what they actually believe to be true. But cognitive biases, behavioral economics is a powerful thing, and people will convince themselves that this position is absolutely justified and it is the biggest opportunity out there. And they'll go through all kinds of confirmation bias research, looking at previous case studies, and convince all their friends that they've got some social proof and feel part of the crowd, and they'll hold on and think they're doing the right thing. But it's not necessarily the case. And this relates to something that's studied in behavioral finance called the disposition effect. And you may have heard of this before. It's a concept from behavioral finance that describes the tendency of investors to sell assets that have increased in value while keeping assets that have dropped in value. So let's say, for example, that you have a portfolio of companies. You've got company A, B, C, D, and E. Let's say company A, since you bought the company, has gone up by 30%. Company B has gone down by, let's say, 20%. So that's down. C has gone up by 10%. D has gone down by, let's say, 5%. Just a negative there as well. And E has stayed the same. Okay, so you're around break even where you invested. So the disposition effect shows that if you have an investor that has these options and they need to, options in alternative companies, not as in financial product options. If you have them in this situation and they need to liquidate for some reason, they need access to cash or they are overexposed, and you tell them, okay, you need to sell your shares in two of these companies, then what the disposition effect shows is that people have a tendency to exit the ones that have made a profit and hold on to their losing trades. There's a really interesting book called The Art of Execution by, I think it's Lee Freeman Shaw, who's a fund manager. And he invested money he was basically a fund of funds. So he invested in different funds, and he used it as a way to study what makes the best fund managers and the worst fund managers, what makes good investment and bad investment. And what he found is that, what the data was showing them was that the companies that were going up, that had risen since they'd invested, were the ones that tended to continue rising, continue to be a good investment. A lot of the time, if this has dropped 20%, there's a reason for that. and companies do continue into decline because there's a drift to lower standards. Maybe it's poor management that's led to them being in that situation in the first place, and so therefore it's likely to continue. There's all kinds of reasons. So people will take their profit simply because, similar to the cruise liners, it's nothing to do with these being the better investments, and it has everything to do with loss aversion, which is a powerful cognitive bias, or let's say a quirk of how our brains work, that the impact of a loss in terms of psychological weight is of a higher value than a profit of the same size. So it hurts us more to make a loss of a certain amount than the equivalent profit would make us feel good. And when we have these situations, it's all about the balance of uncertainty. Oops, weird writing. My writing's never good, is it? Uncertainty versus certainty. So in this situation, where I'm up 30%, if I decide to hold, then I have the uncertainty of potentially making more but potentially losing, whereas if I close, I've got the certainty of having a profit. So in this case, I'm going to exit because I want the certainty of having a profit. Whereas with B, where I've lost 20%, if I continue to hold on, I have the uncertainty of maybe making the loss worse, but maybe getting out of a loss, or I have the certainty of taking a loss. Well, the certainty means taking a loss, so I won't take it, and so on and so on. So people end up holding on to their losers and closing their profitable trades. But if you actually took all these companies at this point in time and they weren't invested in them, and you said to them, which are the companies that you'd most like to put your money in, they probably wouldn't choose the ones that were losing because they'd look at them as not being very good companies. There's reasons that their share price is falling. Maybe one of them has a good opportunity because of that, like it represents value for money, but there's a good chance they won't see it that way. So their disposition effect is their brains, the way our minds work, making them take certain actions that don't align with statements that they actually believe to be true if they weren't influenced by the money they have invested. Now, even though this disposition effect and things like holding on to those cruise companies will still include professional investors, fund managers, things like that, it tends to be that the good investors, professional investors, fund managers, understand how to express your analysis in the right way, that you're making the right statements and not so much getting influenced by other factors that have no bearing on what the market is showing you. So I want to talk you through an example from back when I used to manage a portfolio. And what we used to do is, well, the main part of the portfolio is for focusing on what we called special opportunities. Now, there is a category of funds called special opportunities funds that usually deal in things like distressed assets. That's not what we were doing. We just called it special opportunities because it was for situations where you had a big economic event or a paradigm shift that could be taking place, and we wanted to make sure we could capitalize on it in the most effective way. So what we'd do is we'd identify what the situation was. We'd understand which industries or which asset classes or specific assets are most likely to be affected by it. And like I said before, in any situation where there's a paradigm shift of some sort, there will be winners and losers. So we would want to identify where we thought those hotspots were going to be, where the winners and losers would be. And in some situations, we didn't do it so many times. So when I say some situations, it sounds like it's a lot of times, but it wasn't. We would put together a project team for it. So for example, when we were looking at the fiscal cliff situation in the US around, 2000, I think end of 2012, 2013, we put together a specialist group that we hired just for that, consultants who were going to do research in different areas because they had a specialism in that area. So they weren't specialists in terms of investing or analyzing financial assets. They were specialists from those areas, so they could break down an industry and understand what it all means and where the hotspots are. So for example, we did one looking at the healthcare industry. So let's say that we've done all of our research and analysis, we've dissected the industry, we've gone down the supply chain, and we figured out, hey, there's this company here that if the big players start suffering slightly and have to cut costs and cut out contracts, this one way down the line here is so reliant on this situation that they're going to really suffer. So what can we do next if we've identified this is that company? Well, most investors, most traders will think, well, you could just short that company. But there's a problem here, because what if the industry overall is going to perform well? it's often the case that a rising tide lifts all boats. And if the industry is doing well, this company, their share price could go up. So I might be right that they are going to suffer in that particular area and their share price could still rise and I could end up losing money. So what's the alternative then? Well, you could do a pairs trade where you choose a company you think is going to do well, then this company, and you go long the other company, short this one, and it's the difference between them. But the problem with that is that you're also making certain statements about the other company and you're still exposed to other things. For example, currency fluctuations and other impacts on the markets as a whole. It could be that equities as an asset class are in demand or not in demand. It could just be inflows and outflows and things like that due to the macroeconomic situation, whatever. You're exposed to other things. So the solution that we would come up with is what we called a structured position. Now, structured positions and stuff often refer to making an investment and having an option that's related to that, so that you're capping your downside. It's something that's used in banks quite often for sort of wealth management clients. It's not what I'm talking about. We just came up with our own term for this, structured position. You can think of it as just building a portfolio around a particular opportunity. So we'd identify, okay, what is it about this company we want exposure to? We'll say, okay, it's this thing here. This is what we want exposure to. So we'd figure out what we needed to offset to make sure that this was the only thing that we were going to be exposed to. So we'd hedge off different exposures by taking other positions, so that what we were left with, more or less, and it wouldn't be exact, of course it wouldn't, but to a large extent, that we're left with this. And so what you can do then is take this position, give it to your alien who knows nothing about what you're doing but understands the markets, and say, okay, look through these positions and tell me, what do you think is the thing that I want exposure to? And by sort of cancelling off all of these things and saying, okay, this is all offset, they'd say, oh, you believe that this is going to happen. Okay, this is an oversimplified version, but that's essentially the idea of expressing your analysis in an exact way through the positions that you take. Now, this approach of taking a structured position only really works when you expect there's going to be a big move in the market. Otherwise, all of these other positions that are offsetting something about this are going to reduce and reduce the return that you could potentially make, although it would at the same time be greatly reducing the risk, so there is that benefit. But it's only when you can expect there's going to be something massively disruptive, for good or bad, and therefore a big move in the market, that it made sense to do this. But I just wanted to explain that situation to you, so you understand this idea of making the right statements, that rather than just shorting the company, you're making statements about all kinds of things. It was structuring a position, so you're making a statement about the specific thing that you want it to be. Now, this is something that I think professional options traders, people who are not just on Wall Street bets YOLOing with some cool options or something, taking the vol trade, that is something that option traders tend to understand. Because the thing about options is that you're not just having to express whether you think an asset's going up or down. With different strategies you could take with options, different ways that you can put them together, you can be expressing things about time, you could be expressing things about ranges of prices, volatility, or combinations of different things. And so this is just a screenshot from a book called, I think it's the Bible of Options Trading. I just wanted to put it here to show you some of the different standard strategies that are used and the component parts and what the risk profile ends up being. The idea is that you can have your analysis about what you think is going to happen and then almost exactly express it in the position that you open, so you ensure that you're making the right statements, so that when the thing happens that you think is going to happen, you are profiting in the way that you expect. And when things happen that you don't think will happen, or that you're not wanting to happen, you're protected against those. Like, the statements you're making through your actions are exactly what you're intending them to be, so you don't end up with unintended consequences. Now, I'm not saying that you need to go and learn how to trade options. I very rarely use options. I just want to show you that around the industry, there's this understanding of expressing your analysis with intended statements. And this is something that retail traders don't tend to follow so much. And like I said earlier, I think the reason for this is that the trading industry almost becomes like an echo chamber. And all it is different people teaching things that they've learned from someone else, who's learned it from someone else. And everyone talks about the same things because they want to align with the crowd. Because if you say something different, then everyone says, no, that's not the right thing. And essentially, these people don't have the experience to understand the logic behind what they're teaching. They're just spouting out the same things. Not everyone, but a lot of them, a big part of the industry. So I wanted to show you examples of areas of the same industry, because we're all in the same markets, areas that are not afraid of complexity, that make things as complex as they need to be or as simple as they need to be, but as long as it's making the right statements. And that's the way I look at things as well. It's not about complexity for the sake of complexity. It's about complexity to make sure that you're moving further along the skill side of that continuum and avoiding having unintended consequences and having things coming down to luck. Okay, so I know that that was a lot of talking about things that are not specific to probably the type of trading that you're interested in. But as I mentioned earlier, it's about understanding the logic. And these examples, I think, paint the picture in a much more easy to follow way than just going straight to the trading part. But I want to now switch our attention to trading itself. And I'm going to show my charts and walk you through things with an example of one of my trades. But I want to start off with an overall question that I want us to answer, because this is at the heart of everything else. Now, if you've been watching our videos here on this channel, you would have heard me talk about this time and time again. And I'm going to keep talking about it time and time again, because slowly it's seeping into other areas of this retail trading industry. But still, people aren't quite getting the logic correct. And if you teach one part of it, but not the actual correct logic, then it's just going to end up being useless. So we're going to keep coming back to this. So what I want you to do is imagine that you were following this chart. So it's not from this point, but just as time was going on, you were following this chart and you were going to set an alarm that was going to go off at random times. So it might go off now and then again in 15 minutes. Another time it might be in 5 hours, 22 minutes, random times. And whenever that alarm goes off, you're going to flip a coin, heads or tails, to go long or short. So heads will be long, tails will be short. So you have no advantage in terms of timing the market, and you have no advantage in terms of direction that you're trading. So it's all completely random. Okay, so you might have ended up with it going off here, 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 anywhere, right? And then it's completely random whether it's long or short. So if that's the case, at any point in time, if the alarm's gone off, you can't see the chart, and I flip the coin, long or short, and we're going to do it as a one-to-one risk reward. What do you think is the likelihood of you ending up with a profit from that trade? Would you expect that you're definitely going to lose because it's random? Because if that's the case, then you could just take the opposite side of that. No, we'd say if it's a one-to-one risk reward, you have a 50% chance of profit, 50% chance of loss. Okay. What if you do exactly the same thing, flip the coin? This time, it's going to be a 1-to-2 risk reward. So you're still choosing heads or tails based on flipping the coin. You have no advantage for the timing. What's the probability of a profit? Well, in this case, it's going to be 33.33%. If it's a 1-to-3, what's it going to be? It's going to be a 25% chance of profit. 1-to-4 is going to be 20%, and so on and so on. Now, at Duomo, we call all of these percentages the base rate probability. And it's basically the probability if you had no advantage in the market. And the way you can think about this is to go through a calculation that we call the trade expectancy calculation. I'm having to do a lot of writing here, and my writing is terrible. So trade expectancy, simple way to do this is you take what would be the profitable outcome. So let's say profit outcome multiplied by the probability of that minus loss outcome multiplied by the probability of that. And this will equal your trade expectancy. So for these ones that we've just gone through, the reason that these are the base rate probabilities is because when you put them in this calculation, let's do the first one. Oops, didn't need to do that little line there. Let's undo that. Let's do the first one. What was the profitable outcome? It was 1 times by the probability was 50%, so that's 0.5, minus loss outcome 1 multiplied by 0.5. It's going to equal 0. So all of those base rate probabilities, it's because when you put them through this calculation, you end up with 0. So here's the thing. When you open that trade that's a 1-to-1, you might end up with a profit, you might end up with a loss. And that doesn't mean that it was a 100% chance for profit or a 100% chance for loss. It was still 50%. It just ended up being the profit or loss on that occasion. But if you open those trades, any of these risk reward ratios with no advantage, again and again, you're going to end up with something like this. So you may have seen in studies on something called the law of large numbers that you'll have coin toss trials often used as the example to show you that concept, the law of large numbers. And so what you'll see here is that this is 50%, this is 0%, this is 100%. And this is number of times that it lands on heads. And along this way is how many coin flips. So if we're flipping that coin and it lands on heads, oh look, right, let me do a different color. Look, we're all the way up here, 100%. Next one lands on heads, still 100%. Next one lands on heads, 100%. Next one lands on tails, it's going to drop a bit. And maybe we have a few tails in a row, so it drops down here. Then we get some heads, and so on. And eventually, over time, it's going to drift towards the expected value, which will be 50% if it's an equally weighted coin. This is after maybe like 1,000 coin flips down here. So here might be like after 10, after 100, and so on. Okay, if you look online for the law of large numbers examples, you'll always see this coin flip trial thing. And it's the same with these trades where you have no advantage. Okay, where the expectancy is 0, you can expect this, except for one critical factor. And obviously in the case of the expectancy, that wouldn't be 50% there. This would not be 50%, it would be 0%, right? Except for one critical factor. Every time you open a trade, you're paying a transaction cost. My writing's getting lazier and lazier. Things like the spread, commissions, swaps, whatever it might be. So every trade costs you, whether it's a profit or a loss. So if over the long run, you're going to end up at 0%, then actually, and that's from the trades itself, actually the accumulation of transaction costs is going to put you in a loss. This is why most traders end up losing when they have no advantage. You know, there's this joke that people say a lot of the time when a trader is losing, oh, you should just take the opposite side of the trade. But it's not the case. It's usually that they're not picking up on anything of any note in the markets. It's the equivalent of what I've just shown you, but they don't realize that. And the thing that puts them into a loss over time is just the accumulation of transaction costs. And they think, oh, it's because I've been losing more trades, and if I took the opposite side, I would have been profitable. It's just not the case. You still would have ended up losing because you're taking the opposite side of something that has an expected value of 0, but you're paying a transaction cost that is going to be there all the time. Okay, so I want you to keep all this in mind. Now, I know that I've explained all of this on this channel before, but I want to keep reiterating it so that people start to understand this more and more. But what I want you to think about is this. Let's say you're blindfolded, you can't see the charts. I pick a random moment, I flip a coin, and it's heads or tails, long or short. And I say we're going to enter a trade and it's going to be 1 to 3 risk return. So it's going to be a loss of 30 pips against a profit of 90 pips. And I say, do you want to take the trade? Now, most sane, rational people will say no because there's no advantage. And it will take a real gambler to say yes. But in some situations, traders are taking a 1 to 3 risk return trade. Why? What is the statement that they're making in that case? Now, some traders think that the statement they're making is that I think this is going to end up being profitable, as in they're trying to predict the future like a fortune teller or something, like some Mystic Meg. I had to bring it up because I always mention Mystic Meg, okay? Anyone that's watching this channel for the first time is going to be like, what the hell is he going on about? But I don't know what the reason is, but Mystic Meg just seems to come up in my content more often than she should. She's like living in my mind rent-free, it seems. But anyway, people think that that's what they're doing. I'm entering this trade because I think it's going to be profitable. But we all know that nothing is certain in the markets. You know, all it would take is you enter a long trade, even if you think it's a 100% chance of ending up in profit, a big whale comes in the market, unloads a position, price drops, and you end up with a loss. You know, can you predict that they are not going to do that? Of course not. It could happen. You could have a war that starts, natural disaster, anything could happen that could disrupt the markets. So it's always a probability. So we are making a statement about probabilities. So what is that statement that we're making? So let's say we have that 3-to-1 trade. We know that the base rate is going to be a 75% chance of the loss, 25% chance of the profit. So that would have an expected value of 0. So if we're taking this trade, we are surely making the statement that the probability of a profit is higher than this. And therefore, the probability of a loss is lower than this. Okay, so we're not making a statement that the profit is more likely. You might think you're making that statement, but opening a trade, we're not necessarily making that statement that the profit is more likely, because it would take a lot of an edge to shift these probabilities that this is more likely than this. It's just, there's such a huge gap there. But really, all you need is an advantage here. So for this to be a little bit higher than this, and you're going to have positive expectancy for that trade, which means if you take that trade over and over and over and over again over a large sample size, you're going to be profitable overall, as long as the difference is big enough to overshadow the cost that you're paying, the transaction cost. Now, don't worry if you're not following. We'll discuss this in the coming videos as well. But I just want to point out, like, okay, that's the statement we're making. The more we can connect with that statement, rather than thinking we're having to predict the outcome, the exact outcome that's going to happen, but instead think we just need to find where there's an advantage, then this completely changes everything. And you're going to see from the next statements that we talk through how it relates to this. And the more you can start shifting your thinking to this, the better your trading will be, the more you'll set yourself up for success. Okay, so this is the statement that we're making. And listen, when we think about things in this way, it could be that we actually think that there's only a small advantage over the base rate. So this, rather than being 25%, is 27%. Or we could think there's a really big advantage, like rather than this being 25%, it's actually 60% or something crazy like that. And that will be expressed in a different part of your trade, which I'll point out to you. But the simple fact that we're opening the trade is expressing this as a statement, that we think there's an advantage over the base rate, regardless of what that advantage is. So I want to bring in the charts and talk you through some of the other statements that we're making. So give me a second. Okay, so I want to walk you through some of the key statements that we're making from a high level point of view. As I mentioned earlier in the video, it's not like a series, but the next couple of videos are going to follow along this theme of mental shifts that you need to make to change your perception of trading that will set you up for success. And in particular, the very next one really closely relates to this idea of making statements in the markets, because that's a big part of it. In fact, the making statements is a big part of all of them, but specifically that next one. So we'll go into detail with other aspects of this in that video and help solidify your understanding of this overall concept. But for now, it's just about giving you some high level ones that you click with it and you go, okay, I get it now. Now, to help you understand these statements, I'm actually going to walk you through them by showing you an example of one of my trades from this week. And it's not that I've cherry picked the most spectacular trade. It was just a pretty standard short-term trade. It just happens to be the last trade that I took. It was this week. And obviously this YouTube, this TradingView replay mode, so anyone can say anything about what trades they have or haven't taken. But I actually do live stream trading sessions a few times a week in our community. And this was a trade that on Monday morning, I'd already walked our members through it and explained exactly the setup that I was waiting for, and that I said then that I would be taking that trade, and some of our members took it as well. So when the entry came at 5 p.m. that day, it was what I'd already outlined that morning. So take from that what you will. Now, obviously, as you can see, there's no analysis on this because that's not the topic of this video, and I don't want to distract from the things we're talking about because people get caught up on, oh, I would have done it this way, I wouldn't have done that, you should have done this. It's just noise that ends up happening. So instead, if you do want to have a breakdown of this trade or my trades in general, see the analysis, understand the rationale, click the link in the description box to sign up for our newsletter where you'll get more trading and stuff. But also, like I mentioned earlier, the weekend Nicholas's notes emails where there's some trading insights and then also a breakdown of some of my trades. So then you can see it exactly what was behind this one. All right, so what statements are we making? Well, the very first statement we make actually comes way before we do any meaningful analysis or find an opportunity or anything like that. And it's an area that I think most traders actually neglect and don't give enough thought and attention. And it's about your choice of market. You know, imagine you take whatever markets, whatever asset it is that you're following in a trading session, or maybe it's several markets, and you go and give it to that alien because we're keeping him busy. And you say, why am I following these markets? Well, that alien or anyone really would assume that if you're choosing to spend your time focused on those markets, then it must surely be because you have some sort of advantage, or because you have a reason to believe that that particular market is going to be more likely to give you opportunities than other markets for a particular reason. So having an advantage might mean that you have some specialist knowledge in a particular market. Like maybe you're looking at a particular equity or a commodity and you've worked in a relevant industry. Or maybe you're trading a certain currency pair because you were on that currency desk at a bank for decades. Whatever it might be, you have something that other people don't have. Or with the opportunities, it might be because you've spotted something about that particular market that leads to the type of opportunities that you're looking for. Because it's just like when we were talking about the cruise liners earlier, that when they were invested in those cruise companies, they were making the implicit statement that this is the best place for my money. Otherwise, they could have sold their shares and put their money elsewhere. In a very similar way, when we're following a market for a trading session, we are making the implicit statement that this is the best place to spend my time, because if not, you would be following a different market. So there are advantages of following one market through thick and thin, because you develop a certain implicit knowledge that you wouldn't have otherwise, a connection with the market, a deeper understanding. But there will be periods with any asset, any market, where there are periods of really shitty activity where you know that it's not going to be great opportunities, and either you end up forcing things that you know you shouldn't be trading, or you don't trade during that period, or you just burn your mental energy trying to figure things out before you find like a trade that's like barely anything. And so in those moments, you could be switching to other markets that are better, and you wouldn't lose the implicit knowledge that you've gained. So people just stick with one market because they think that's the right thing to do, or they don't want to focus on other markets. Or some people will say, well, it's because my strategy works with that market. And that's usually a good sign for, and this is going to get me in trouble with some people, but it's usually a good sign that actually your trading approach doesn't work and you're riding a wave of luck. If you get a bunch of data from a random trading approach, then it's the law of small numbers. You'll be able to find one market out of the bunch of markets you've looked at that outperform the others, because that's what happens when you've got small sample sizes. And then people stick with it and say, oh, it works only on this market. On the other hand, you have traders who skim through lots of different markets during a session and just wait until they see a setup or something on one of them and they go and trade that. And then they lose out on any kind of implicit knowledge from different markets. They burn mental energy throughout the entire session doing endless amounts of analysis. So when it actually comes to the point of opening the trade and managing the trade, when their decision making matters the most, they don't have the energy to do it as effectively as they could have done if they had saved their mental energy. And they become too reactive. They see something coming up, they jump into it, they force things. It just doesn't lead to good trading. So after many years of doing this and having seen it with many other traders, I firmly believe that great trades come from great market selection. So I always encourage everyone to have a market selection process. And actually, just like with the other things I was saying about making statements, this is something that you tend to see investors doing a lot more than traders, because there aren't many investors out there who are going to sit and read through the financial reports of every single company in the S&P or something like Warren Buffett does. Instead, they're going to use something like a stock screener, where they put in certain criteria that are aligned with the type of opportunities they're looking for, and it will filter out most of the companies so that they're left with a short list to go and research. So that's a form of market selection. It's making sure that their time and their mental energy is spent where it's more likely to lead to opportunities that they actually want to pursue. And traders don't tend to think this way. But I will be putting out a video very soon that's all about the market selection process after the next couple that I've got planned that are about these mental shifts, because I think everyone needs a market selection process. And just briefly with this one, so I chose this market for this particular session. It was Monday, what was that, the 1st of September, I think, because it met certain criteria for a certain type of opportunity that I look for. And so the thing that I do, you can see over here, is that I have this section up here for my session focus, and I'll have sometimes one, sometimes two, maybe three, like just a few markets that I'm focusing on for the session. Then I've got backup markets that are in a decent area for looking for opportunities, but not the ones I want to focus on. So if one of these markets, like the thing that I'm focused on them for, disappears, like something disrupts that market and now it's not looking like a good area for the opportunity, I'll take it out of there, add one of these in there instead. And then there are others that I'm not following, but maybe I've updated analysis and I'll maybe move them into backup markets when I need to. And then I have these colored tags, and these represent the different types of opportunities that I am looking for, because I don't just want to follow the markets until a trade comes up. if a trade does come up that's positive expectancy, I'll take it. But I'd rather my attention is focused on specific types of opportunities that I know will give me the best bang for my buck. And the way I think about it is this. We can think about time, so holding period, and potential returns. And you have high, low, and you have low, high. You can think of it as like quadrants. So obviously, the best situation is low amounts of time, high return. Then you've got high amounts of time, high return, which is okay. And what you definitely don't want is low return, high time. So you don't want these ones. So the preference is I want to find situations like this. If I can't find those, I want ones that are like this. And if I can't find those, I'll go for ones that are like this. And I never want these ones. Okay. We'll discuss all of this another time, but it's part of having a good weekly or daily routine to find these things. But anyway, when we are following a market, that's the statement we're making. This is the best use of my time. So have a think about your trading and think if you genuinely think that with the market you're following each day, or if you're forcing things. Because I always think in the markets, you can't polish a turd. Sometimes markets are just shit during that period of time. And rather than forcing yourself to find something there, just move to an easier market. Make life easy for yourself. Okay, so we've chosen a market. We've gone through our analysis, which, by the way, as you might have guessed, we're also making certain statements, but that's all what we'll discuss in the next video. And we get to the point where we think there could be an opportunity. Now, there are a couple of statements that we're making here. And by the way, I just noticed that EuroCAD is highlighted here because that's the last one I chose from this list, but we are looking at Aussie CAD. Just want to make that clear in case anyone starts looking for this point on this chart. It's because I had to just open a different broker one for Aussie CAD so that I'm not disrupting my own analysis when I remove everything from the chart. Okay, so what's the first statement that we're making? Well, it's going to be about timing. What's the reason that we're opening the trade right now and not before, not after? Why now? Is there a reason to think that now is the right time? Now, some people don't have a reason with timing because they don't know with the short-term movements whether it's going one way or another or what the chances are of that or where there's the better area of opportunity. They just know about the bigger picture opportunity. So then they're sort of aligning with the famous statement from Reminiscences of a Stock Operator where the guy who is basically Jesse Livermore is told by the older experienced guy that sometimes you just need to be in the market. If you believe that it's going up, be in the market, don't try and time it. So some people think that, but for those of you that do try and time the market, what's the statement you're making? You're saying that now is the right time. And if we think about what we went through before about when we're entering a trade, what is the statement we're making there? It's about expectancy. Well, if we are entering a trade now and not before or after, the statement could be that this is optimal for expectancy. Or alternatively, it could be that right now you see that you've got positive expectancy, but there's a chance that if you wait, it won't have positive expectancy. So you'd rather take the trade now, even if it could be better expectancy, because it could also be worse and then there not be an opportunity. Okay, I know it's a bit of a mouthful to explain. So positive expectancy, that may go away. Now, what we don't want to be making statements about is the situation I see happening a lot for traders where there could be an opportunity. And the key word here is could, as in it's not currently an opportunity, but there may be a setup coming. And they're so worried about missing it, they get anxious that they enter the trade, and it's because of FOMO. So if you take away the FOMO bit that someone else can't feel for you, you feel the FOMO, but they can't feel it. So if they give you an objective view of your trade that you've taken, then they'll be saying, okay, right now you think it's positive expectancy. And if actually you don't think that, then there shouldn't have been a reason for you taking that trade. So in the case of this trade, my timing was after the close of this candle. There was a particular setup. There was a reason for entering right then based on analysis from multiple time frames. So at the close of this candle, it was 5 p.m. UK time, entered short. Now, the fact that I'm entering, as we discussed before, is that I'm expressing a statement about the expectancy of that opportunity. I'm saying that the probabilities, higher probabilities than base rate. Okay, now obviously, if I'm going to make that statement, then I need to understand what the probabilities are. But I can't estimate the probabilities of something without first knowing what that something is. And this is something that I think a lot of traders actually get quite wrong. For example, there are lots of traders that trade based on purely indicator-based strategies, and ones where they'll enter when the indicator shows them something and then exit when the indicator changes to show them something else. So let me show you what I mean with a quick example of one that I think most traders learn when they first start, when they're experimenting with different strategies, until they quickly realize it's useless. A moving average crossover strategy. So you maybe have moving average like this. This is not going to be visually accurate, but I'm just doing this to paint the picture. So let's say that you have these two levels and it crosses over here, and it's an indication that you're going to go short. It wouldn't make sense with the structure we have here, but anyway. So you are going to go short here. Okay, maybe it's here that it happens. Now, if we're going short, then we're saying that we think the probabilities are better than the base rate. But how can you say that when you don't know where you'll be exiting the trade? Do we know ahead of time where these will cross back over again to exit the trade? No. So then how do we know what the potential outcomes are? And if we don't know what the potential outcomes are, how can we estimate the probabilities of something? You know, how, if I say price could go up and it could go down, estimate the probabilities of that. Well, the first thing you're going to know is, well, how far up or down? And that's exactly the problem here. So we can't call this an opportunity if we don't know where we're going to be exiting, because how do we know that we've got an advantage over the base rate? And that's exactly what lots of traders do when they do things like this, where they'll say, okay, price has been doing this and now it started to break out, so I'm going to go long because I think it's more likely to go up. Well, go up where? And more likely than what? I mean, 1 pip, 10 pips, 30 pips? And then maybe they'll put their stop loss down here. You know, say it's more likely to go up than to hit that stop loss. Well, sure, but if you're talking about it going this far and the stop loss is here, then that's asymmetric against you. So it's like, you know, it might be that's a 1 to 4 or something, in which case you're expecting that there's an 80% chance of it hitting your profit rather than hitting your loss. But if you don't have an advantage over your base rate, then the expectancy is still going to be 0. So yes, it's more likely to hit that profit target, but you're not going to make money doing that over the long run. You're going to lose. So we need to define where we're exiting. And a lot of traders will say, oh, I exit when it shows signs of, you know, that is reversing. Well, fine, but you need to know ahead of time at least a minimum of it. Now, this ties in very closely to what we'll be talking about in the next session, so I don't want to get too deep into this because I'll really outline a lot of the different statements that people are making without realizing it there. But if we just accept for now that we need to understand the potential outcomes and the probabilities, and if we're wanting to estimate the probability of something and to be accurate, then it can't just be an outcome that we've chosen sort of arbitrarily. It has to be based on something, because it needs to be something that can be measured and tracked in some way based on something that has meaning. And again, that's something we'll elaborate on in the next session. So we have the fact that we're following this market in the first place, that this is a better place for us to spend our time rather than a different market. We have the fact that we think something is an opportunity is a statement about probabilities being better than the base rate, which implies then we understand about what the potential outcomes are in order to be able to say that the probabilities are better, that we have some advantage. We have the timing, entering short at the close of this candle. And then finally, we have the position size. So the position size, how much you're going to be risking on a trade, we are making a statement with that. So let's think about the statements we're making here. So some traders use what we call static position sizes or static percentages at risk. So that means that for every single trade, the percentage at risk is the same. So let's say for every trade, they risk 1%. Oh, that was a really weird percentage sign. There we go. Or some people use static position sizes, which means that the position size for every trade is the same, like maybe it's 1 lot or something. And so what statements are being made here? Well, if it's the same percentage of risk, they're saying that every opportunity is equal to them. There's no differentiation. They don't want to be risking more on a better opportunity, risking less on a worse opportunity. All of them are the same. And if you're using a static position size, where it's like 1 lot per trade, but you're using different exit points in a loss, so different placements for a stop loss or something, then that means that in some situations you're risking more and in some situations you're risking less, but it's not defined by the opportunity itself, it's defined by how far the stop loss is. So let's say you have opportunity A and opportunity B, and in opportunity A the stop loss is 20 pips, and in opportunity B, the stop loss is 50 pips, then if you're using a static position size, so one lot for every trade, you're risking more for this trade than this trade. So therefore, if you give it to the alien who's going to have an objective view of it, they'll say you think this is the better opportunity. That's why you're risking more of your capital on it. But it might be the case that you think this one is. So where's the logic there? The statement you're making doesn't align with what you actually think. And some people aren't even thinking about which opportunity is better or worse. So they don't know whether they're making the right statement or not. So instead, it's much better if we use a dynamic position size where the amount that we're risking is aligned with what we think of the opportunity. So for example, for some trades, you might risk 0.5, another one you might risk 0.6, another you might be risking 0.8, another 1.5, and so on and so on. But the key question then is, how do you choose the percentage at risk? Well, we can think through what statement is the percentage at risk making? Well, it's going to be making a statement about the quality of the opportunity. And how do we know the quality of an opportunity? What's the best measure of how good an opportunity is? It's going to come down to expectancy. If you run the expectancy calculation and you find that one trade is going to give you an average of 0.5 R for each trade that you open, which means whether it ends up being a profit or a loss, if you keep taking that trade over and over 1,000 times, then on average it would have generated 0.5 R per trade. So if you've got that one and then you've got another one that's actually 0.8 R, well, which one is the better opportunity? This one. It might be that this one over here is more likely to result in a profit for that specific trade based on the probabilities, but this one is the better opportunity. So which one's better to have the higher amount at risk? This one here. Now, there is an aspect of trading psychology here, and I've talked about this in a video before. I'll put it on screen actually, so you can click up there to watch it if you want, where some trades will have a much better expectancy, but a higher probability of losing, and therefore you can expect a drawdown to occur in the short term, and if you're risking more on those trades, the drawdown is going to be deeper, and for some people this is going to trigger things like the break-even effect or not being able to make the same decision making that they should be making, where they will start taking actions and decisions that are making the wrong statements because they are going through some sort of loss aversion or revenge trading and things like that. But that's out of the scope of this video. You can click that video up there and learn about that. Okay, so all of that is at the entry point of the trade. Okay, so there's all these statements that are being made. We've got the fact that you're entering a trade is making a statement about having an advantage. The position size or percentage at risk is making a statement about how much of an advantage you have. Okay, so what this means is that you could take that trade, give it to someone else and ask them what statements I'm making, and they'll be able to tell, okay, the fact you're entering a trade means you think there's an advantage over base rate. The fact you risked more on this trade than this one means that you think the advantage is bigger on this trade than this one. Okay, so in the case of this trade, my trade, you obviously know that this was the entry point, and the timing of that was based on that being the specific point where I expected there to be a shift in activity, which means whatever activity was causing the imbalance that caused the move up to that point, there was likely to be a shift in activity there that would either put an end to that imbalance and potentially cause an imbalance the other way. Okay, there's something I identified there that I thought would cause that shift in activity. So that's a defined point. I can then look at where the next shift in activity could be. So the next outcome this way, negative outcome, and I could do the same for this way. So let's say it was down to here and up to here. Then in terms of my stop loss, or where I would exit in a loss if it was moving against me, then I would place that stop loss at the point beyond which the probabilities of the negative outcome playing out are so much higher than the possibility of the positive outcome playing out that the expectancy beyond that point is negative. So I call it the tipping point of the trade, tipping point where things have shifted. Okay, so that's where the stop loss goes. And then in terms of the positive move, so profitable move, I don't use a take profit level. I use what I call a TMP. It's a trade move potential. Another way to think about this is just the first decision point. And there's a good reason for this. And it kind of ties into the next bit, which is all about what you do during the trade. So I see many traders opening trades with these huge asymmetric risk return ratios. Like I've heard this crazy statement where, and it's from a really popular YouTube channel and company that teaches people how to trade, a nonsense approach, where they say, when this chart pattern happens, then in 90% of the cases, it's going to reverse the entire impulse move that led to it. And they end up with something like this, where it's like, okay, pattern here breaks that, and they're putting their stop loss here, and then they take profit down here, and they end up with a trade that's like a 10 to 1 or something, or 1 to 10. So let's say, for example, that is a 1 to 9, just because it keeps the maths easier. So if you've got a 1 to 9 risk return, then the base rates, let's do BR, those are going to be 90% chance of the loss and 10% chance of the profit. So for us to say it's the other way around, you have to have such a massive edge. And if you just do the expectancy calculation of this being the other way around, where rather than it being a 90% chance of loss, it's actually 10% chance of the loss and 90% chance of the profit, okay? And figure out the expectancy of that, and imagine you're taking those trades every day, and just see what a short amount of time it would take for you to be like basically the richest man in the world. I mean, it's completely ridiculous, and it shows a real lack of understanding of probabilities and how the markets work. But anyway, that's a topic for another time. The point I want to make for now is about what statements you're making if you have these huge risk reward ratios. So let me make it really clear for you. So let's say that you've got that move up that's happened, and you decide, okay, this is going to be where my stop loss is, and my take profit is going to be down here, and I'm going to use a set and forget approach. Okay, set and forget. Okay, so what statement are we making if we have a set and forget trade that's a 1 to 9 risk reward? We are saying that there's nothing that can happen between this point here and this point here that will disrupt this trade in any way or lead me to exiting sooner. That is the point. Down here, that's the only point I want to exit. But here's the thing, the traders who take those trades, if you say to them, first of all, okay, I get that, you think it's going to retrace all of this impulse move, how long will it take to do that? Well, they can lie and give you a time. Oh, it usually happens 90% of the time in 2 days or some bullshit. But if they're being honest, they'll say, I don't know. Because no one knows. It could take weeks, it could take months, it could take hours. Who knows? It might do it like this, it might do it like this, it might never do it, right? We don't know. So, okay, if we don't know how long it will take, could it be that it takes a week? Yes. Could it be it takes 2 weeks? Yes, okay. During that time, could something happen that disrupts the trade that's out of your control? Could there be a natural disaster? Could there be a war? Could there be a central bank decision? Could there be something to do with tariffs? Could there be NFP? Could there be earnings releases? Is there something that could disrupt it? Oh yes, NFP might come out in between and that could disrupt it. Okay, so there's something that could happen that could disrupt the trade. Now, are there any levels in between where if the price struggled there, you'd think, oh, this is not looking so good, and that somehow whatever you thought at this point in time, the probabilities have changed? Usually they'll say yes. Like for example, if price gets to here and struggles and then it's back here, they'll probably say, okay, it's not really going to work out. Okay, so there are things between this point here and this point here that could disrupt the trade, right? So if those things happen, they have two choices then. They can either exit the trade early, or they can hold on to the trade stubbornly just because they set it as a set and forget, knowing that the trade has been disrupted. And in both cases, the original plan they had for the trade, or the original statements they were making, don't make sense. Because remember, when we enter that trade, we are making a statement about probabilities. Okay, so this is base rate. We're making a statement about these. We're saying that the probability of this is higher than this, and the probability of this is lower than this. Okay, now if you're exiting sooner, well, it's not a 1 to 9 anymore. Maybe it's a 1 to 4. So then the probabilities are different. Do you still have an advantage? How do you know? And if you're holding on to that trade and something has happened at this point that's disrupted it, well, then the probabilities are different to what you were anticipating at this point in time. So still the calculation is different. Now, I'm not saying that it can't be that you still have an edge for that move there. What I'm saying is that you could be opening yourself up to unintended consequences because you were not factoring that in at the point of entry, and therefore the expectancy calculation, the whole rationale for the trade, is different. So you've made an inaccurate statement, you've made an implicit statement through your actions that you didn't follow up with, that you didn't believe in. So that's why I use TMP, because I'm not setting a take profit level there and exiting, because I'm not saying that's necessarily the extent of the trade. I'm just saying that's the first point where I'd want to make a decision, whether that decision is exiting the trade, moving stop loss, scaling out, whatever. Now, there are two big advantages of doing things this way, of using the TMP, the first decision point, in the way that I'm explaining. And they're all about making the right statements. Surprise, surprise. So the first thing is that if I use the TMP, the first decision point, in my expectancy calculation to assess whether it's an opportunity that's worth taking, I'm basing that calculation on worst case scenario rather than what many traders do, which is best case scenario. So having a risk reward ratio of a 1 to 9 or 1 to 10, knowing that you'd probably exit sooner, is making your calculations about whether this is an opportunity based on best case scenarios. I'm using worst case scenarios. Why? Because I want to make sure that my statements are accurate. So if I'm saying that there's a chance things could be disrupted in the markets, or I don't know what the markets will be like when it gets here, but I know that regardless, I won't make a decision until it's there, so I won't exit any sooner than this because that's the first order outcome, then my statement's going to be accurate, okay? So the probability we're getting here has to count the fact that it could get disrupted en route and head this way. But that means that I'm using the worst case scenario, okay, rather than assuming the best. The second thing is that my probabilities are going to be more accurate, because the further ahead you go, the further out from the current price, the further ahead in time, the more inaccurate your probability estimates are going to be, because you don't know what will be happening at that point in time. If this is just here, I can assume what the price will be like approaching that point. Can I assume what the price will be like all the way over here or like a week later? No, it could be moving with momentum. Activity could have completely dried up to nothing. It could be reacting to every level there. It could be that something's happened in the market, it's completely transformed everything. Anything could happen. So how can I rely on a probability estimate way out there in the future? You can't. So maybe the person taking this trade had an advantage right at the point of entry, but beyond a certain point, it's going from skill into luck, because they have no idea what the price will be like down here. And so either they're going to exit early or they're holding on based on luck. And that's what I don't want to be doing. So I use TMP and then I make my decision. And in this case, I won't talk you through the whole, what my strategy for this opportunity was. And when I talk about strategy, I'm not talking about the way most people talk about strategy as like a predefined thing they're doing. I'm talking like the strategy for this specific opportunity. Again, I've said a million times, that's something we will be discussing in a separate video soon. Okay, so let's really quickly talk about what then happens during the trade. So what statements are being made here. So this is what happened next. We then reach TMP, where I've got to make a decision. So we talk about trade management, the actions you take when you're in a trade. But at Duomo, we also call that same thing strategic risk management. And the reason we call it strategic risk management is because if you think about it, once you're in a trade, all of the actions that you can take are some form of risk management, whether you realize that or not. You could scale out, so taking part of your profit. That means reducing risk. You could scale in, which means increasing risk. You can move your stop loss. So of course you can widen the stop loss, which means you're increasing your risk, or you can tighten the stop loss, which means reducing risk. And then you can exit the trade where you're removing your exposure completely. No exposure. So you're managing your risk in a strategic way. It's strategic risk management. So really, there's a limited number of things we could do when the trade's open that fall under strategic risk management or trade management. And obviously there are other things that we can use like derivatives or, but that's not really what we're focused on here. So we have to think about what statement we're making with those. And the funny thing is, all of the trade management stuff is just the same stuff we're doing at the point of entry, but just on an existing position. So if you think at the point of entry, we're looking at possible negative outcome, possible positive outcome, and the probabilities of them. And at the time of entering, we have a stop loss, which is what I call the tipping point, the point beyond which the probability of this is so far that it ends up being negative expectancy. We have the percentage at risk is going to be based on the expectancy. But what happens when you're already in a trade? So at this point, well, my stop loss would still be where it was originally. Does it need to be there? Am I not wanting to cap the point beyond which it's negative expectancy so I could move my stop loss? If then based on the next potential outcomes, because obviously this is one outcome, I could look at the next outcomes, the expectancy is worse than at the point of entry, I can look at the percentage I have at risk and reduce that. If at some point the expectancy improves, I can increase the percentage at risk. So it's just the same as what you're doing at the point of entry, but on an active position. So in my case, as I'm at that first decision point, I have a trade that's broken across 2 different time horizons. And for the short time horizon, the expectancy has now changed. So I chose to exit 30% of the position. And then later on, we have another move down and we end up in this region and I exit another 30% at that point. And these are based on a change in the expectancy at that point in time. And so at that point, I obviously had 40% of the position open. So I do the same thing, look at the potential outcomes, move the stop loss based on that, and then continue going. And in this case, the price then reversed up, hit the stop loss, and therefore that was showing me, well, beyond this point now, it would have been negative expectancy, so we're getting out of the trade. Okay, so it's the same decisions at the point of entry, but throughout the trade. And if you want the full breakdown of this one, like I mentioned, you'll get it in this week's Nicholas's notes. There's just something I quickly wanted to add here that I missed the first time around that I'm coming back to. There's a really common incorrect statement that traders make. It's like widespread. Lots of traders are taught to do this. Lots of traders do this as standard on every single trade. And that is moving your stop loss to break even once it starts moving into a profit. And the thinking here, the statement that traders think they're making, is that they now have a risk-free trade. But the market doesn't know about where you entered your trade. I mean, technically, yes, it does, but that's not really influencing where the price goes and what the probabilities are of the different outcomes. So if we're entering a trade saying the probability of this outcome and this outcome makes it positive expectancy, moving the stop loss to break even before one of those outcomes has taken place is reducing the probability of the positive outcome, because we're now ruling out the possibility of this. So whatever percentage probability we had at the start when we were figuring out if this is an opportunity has now changed. It's not actually in line with the calculation we had. So for this specific trade, yes, it's risk-free in the sense that you're not going to end up with a loss. But if we take 1,000 trades, and there are some that could have been profitable that now end up being break-even, it can completely change what the expected value is of all of those trades. That in the long run, you might have taken an opportunity that was positive expectancy and made it negative expectancy. And if we think about the statement that we're making, if you took this trade where you've moved your stop loss to break even and you go and give it to that alien or someone else that doesn't know what you're thinking and say, what statement am I making? Well, if they understand the expectancy and that kind of thing, they'll be saying something along the lines of, beyond that point, it's negative expectancy. But that's not necessarily the case because nothing has materially changed since the point that you entered the trade. So instead, you should only be moving your stop loss to either break even or somewhere else when that becomes the tipping point beyond which your trade would be in negative expectancy territory, because that's what's going to lead to profitable results over the long run. The problem a lot of traders have is that they think about their trades as individual things rather than thinking about them in terms of probabilities, which requires you to think about a larger sample size. Look, I know that a lot of what I've explained to you can either come across as too complex for the stage you're at now, or maybe there are certain things that I haven't explained in a way that's clear enough to you. I understand that that could be the case. But rather than just disregarding all of it and thinking, I'm just going to stick with things that are simple, try to get your head around it. And if you have any questions where I haven't explained something clearly enough, or maybe I've missed out something, just ask me in the comment section. I'll be happy to help. Because if you can really click with this concept and understand the use of it and start aligning yourself with this and the stuff we're going to discuss in the next videos, I really believe that this will set you on a better path for your trading. And I know that in this industry, there's this race to simplicity, but sometimes things do need a certain amount of complexity, just enough complexity to do the job. Trying to make everything as simple as possible isn't necessarily going to lead you to success. Sometimes things do need to be a little bit more complicated. And if you always avoid that and take the path of least resistance and go for what's easy, you're not necessarily going to achieve your goals. So if you can at least understand the underlying message here and understand the concept and start trying to think through your trading and how it applies, it will set you on a much better path. Same with the next videos. And if it is a bit too complicated, I'm sorry. I've tried my best to make it as simple as I can, but these things are tricky to explain. And I've refilmed this many, many times. But of course, some things are going to be difficult to understand and some people just won't click with it. but give it your best shot. Rewatch it if you need to, ask questions if you need to. Don't just give up on it and think, oh, he's making things more complicated than needed. I really mean what I say with this, that this stuff is necessary to at least be doing in principle. I mean, at the end of the day, this is what trading is all about. If you're going to summarize what the skill of trading is, it's the ability to analyze the markets, to understand when you have some advantage from a probabilities point of view, and then to be able to express that analysis in the correct way, making the right statements through the actions and decisions that you take. And anything that overly standardizes things by saying, I'll do this way in every single case, all it's doing is not reflecting the analysis correctly. And vice versa, if you analyze everything in exactly the same way every time, it's just standardizing things so that the statements you make through your actions, even if you change them each time, is not going to accurately reflect that. So it's about the skill of being able to understand the situation and then reflect that through your actions and decisions. So if you're avoiding that because it doesn't sound simple enough, then you're not really developing the skill set that you need to succeed. And that's what I'm trying to get across to you, is like, there's a certain level of complexity that's necessary if you want to succeed here when we get to what is actually at the heart of what trading is all about. And so just briefly, I want to explain the other two that are here. So obviously in the case of this trade, the exit point was from a stop loss hit. But if you manually exit a trade, what is the statement that you're making? Well, if entering a trade is that you have an advantage above base rate, exiting the trade should be the opposite, that you no longer have an advantage above the base rate. Because if you did, maybe you'd want to stay in that trade. However, we also need to consider this over here, which is the opportunity cost of staying in a trade. And HPR is holding period return. So if we think about the cruise liner example, that having your money held up there, you're making a statement that this is the best place for my money. It's the same when you hold the trade beyond a certain point. So it might be that you have the initial part of the trade, like let's say you were entering here, you have the initial part that's quite quick and you've built up a profit, maybe like 2% or something. And then it's like this for a very long time and you're still holding because you think eventually there's more potential. But during all of this period of time, let's call it in the markets will be 5 days, could that money, and that not necessarily just the money, but also your mental focus and everything like that, could that have been given to a different market where there's more potential? So the best way to think about this is the holding period return. If something's below a certain holding period return, it's not worth your time. Focus on markets that have a higher holding period return. But again, I know I've said this a couple of times. I'm not intending to explain all of these in full detail now. The whole point of this was just to briefly walk you through a few different statements that are being made so that you understand the concept. But if you want a full explanation of these and other statements that are made throughout the process, let me know. But what I want to do now is to move on to that next video where we're going to talk about a mental shift that's even more impactful and even more important than what we've discussed now. This one ties into that. It's like we've laid the foundations and now we're going to build upon that, because this next one, I believe, is probably the main reason that most traders end up failing, because when you understand what we'll discuss in that next video, it changes the things that you focus on to improve your trading. It changes the sorts of actions you take, the trading approach that you choose to use. It changes a whole lot of things once you have that perspective shift. And it's something I don't see very often in this industry at the moment.